The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The economic data wasn't quite enough to move the markets, but maybe Nvidia will. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Griffeo. We're kicking you off to the closing bell here in New York on a day when we do have those Nvidia earnings coming up in just about an hour. Stock traders not really looking to put on a lot of risk ahead of that report. The S&P 500 basically unchanged, just a little bit in the green. NASDAQ 100 looking about the same. Nvidia down about 1%. As a reminder, the stock was up yesterday, but it's down about 6% in just the last 2 weeks. That inflation data that we got, the PCE, it was in line, but it didn't move markets that much. It does have traders pricing in potentially a Fed rate hike for February, so it did bring yields up. It also brought the dollar up. That Bloomberg US dollar spot index at one point rising the most since July.
Absolutely here, and the bookends to this trading day couldn't have been more consequential. We started off with that PCE report, stall speed on the spending side and persistence on the inflation side. That core price index at 3.3%, a growth rate that has been consistently above 3% for 7 straight months now with no signs of deceleration. That curbed the 2-day drop in U.S. Treasury yields, put upward pressure on the dollar, and left equity investors largely on the sidelines until at least tonight. Nvidia is set to report earnings just a little more than an hour from now. And it's not solely about revenue and earnings, both of which are projected to have doubled from a year earlier. But most of the attention, it's going to be on Nvidia's off-balance sheet activity and the intermingled relationship with its chip buyers as it evolves into an AI finance house. But as the company evolves and as, well, competition increases and as a lot of the scrutiny over the AI build-out intensifies, valuation questions, they do abound. Even with the market cap of $5 trillion, Nvidia's valuation right now, it's been eroding steadily. At roughly 20 times its projected earnings over the next 12 months, the multiple is about half of what it was 3 years ago, the cheapest it's actually been since about late 2018. That, of course, was before AI exploded and when the market value of the company was just $100 billion.
I still think that over the next couple quarters, and I'm not sure if it's this print, if it's the next print, they're going to beat expectations again. People are going to realize that Nvidia is trading at close to 20 times and growing at close to 100%, and that those two things don't make sense. And I think at that point that the stock takes off. That's why my price target is north of $300. It's just, from my perspective, it's when does that realization kick in? Because I don't see anything stopping Nvidia's growth.
Matt Bryson, who was on our show yesterday, talking a little bit more about that multiple as you see it there right now hovering near some of the lowest levels since 2018. And maybe, well, just maybe that's a buying opportunity for some folks out there. So let's go from one Matt to another as we kick you off to the close and kick you off to Nvidia's earnings with Matt Stucky, Chief Portfolio Manager for Equities at Northwestern Mutual Wealth Management. And Matt, I do want to start there basically on what your expectations are for tonight, but primarily in the context of sort of what it would actually take to actually see, I guess, maybe that multiple come up, if that would be a good thing in your view.
Well, good afternoon, Romaine. Look, I mean, I think this is going to be another quarter for Nvidia where their growth is simply, a continuation of the growth of their supply chain. They remain somewhat supply constrained, which has kind of been the case the last few years. And so, the volatility around the fundamental report that we've seen the last 2 to 3 years really is just a reflection of how much capacity they've been able to expand. And so in terms of my own expectations, in terms of top line for the second quarter, around $94 billion, guiding to at least 107, looking out to the next quarter. So, a beat to consensus and a beat to guidance in terms of where the sell side is. But I think the main question is, there's been a lot of frustration for the part of investors that multiple has compressed. And, there's a lot of head scratching going on about why that's taking place, because it's somewhat unique to Nvidia. Looking at the rest of the semiconductor space, Nvidia trades at a discount to the rest of the industry. And so you can have your own view on kind of, the sustainability of spending in this space. But, what's interesting to me is that you look at their product leadership there, is that eroding or not? And I don't think that we know enough yet to make that call that they should deserve to trade at a discount to the industry.
Well, yeah, and it's this idea, we know that the competition is coming. I haven't yet to hear anybody actually say the competition, at least in a scalable way, is actually here. But is that maybe what investors are looking to? I mean, if you are pricing for the future here, you have to think about the idea that its share of the market, whether it's GPUs or CPUs, might be a little bit smaller than what it was, over the last couple of years.
Sure, that's a point that's been well debated. Today, if we're looking at calendar year 2026, their market share in the accelerator market's around 80% or so, and next year, with the growth of custom ASICs and a growing impact from AMD, maybe that slips 5 or 10 points. But in that slippage, the entire market is growing pretty significantly, and Nvidia's growth next year could be well north of 50% year on year. And so, yes, they might be losing a little bit of market share, but it's in the context of a very rapidly growing industry pie. And so it's difficult to see continued multiple compression continue forever when you also, alongside that, see upward revisions to estimates. Those things don't typically correlate with one another.
What about, the stock reaction? Because we've seen the last few reports, Nvidia's beating expectations, but the stock has fallen after the results. How high is the bar right now?
I don't necessarily think the bar is really all that more elevated than it was in prior quarters. At the same time, I don't think that there's enough growth in the supply chain for them to report just a blowout number that really gets investors excited, that restores that multiple. And so the question is, how much insight do they give to their fundamentals in calendar year 2027 and 2028? They've been pretty hesitant to guide that much into the future. They typically guide just a quarter at a time. And so, maybe that is kind of the unlock in terms of multiple support, is that they talk about, the amount of product that they have already pre-sold in terms of looking ahead into 2027 and beyond.
When it comes to Nvidia's, recent announcement that they're going to be doing $500 billion of financing to build out AI infrastructure across the ecosystem, what do you want to hear from them in these results when it comes to circular financing and just all of the investment that they're making in the space?
Yeah, I think this is a newer topic, and I would add some context here in just saying this is not necessarily vendor financing. This is the organization of third-party capital with the backstop from Nvidia, and if they can disclose more on the call about kind of what that ultimate backstop looks like in terms of sizing. I know they talked about how they're going to backstop maybe 25% of the deal, and it's a case-by-case basis. But some more specifics around the structure. Do they guarantee a price for a rental price of the product that they put out there in these deals, or is it a hard number in terms of capital at risk? Either way, I think that it plays to their strengths. It plays to their strengths in terms of enabling their ecosystem to proliferate beyond just their typical set of customers today and the hyperscalers that are buying so much, and also in terms of if they have to take on capacity, what do they do with it? And what I mean by there is, do they train their internal open source models, which increasingly are becoming more competitive with the likes of Kimi and the other open source models that are out there?
But does that raise any questions? I mean, we talk about this idea of how much of its revenue is actually being driven by pure demand and how much now might be driven by more of its financing, or at least its involvement in that financing. Does that matter to you?
It does, but what evidence is there out there that we are in an excess demand environment? I think you go through every hyperscaler earnings this past quarter, and what you see is an enormous growth in their backlogs, and the continued message is that they simply just cannot supply enough. And so, to me, I think that this move to arrange third-party capital to expand compute capacity out there is a reflection of just the environment that compute remains tight. And it just takes a while to bring capacity online.
Matt, always appreciate it. Matt Stucky, Chief Portfolio Manager for Equities over at Northwestern Mutual Wealth Management, kicking us off to the close and kicking us off to those earnings from Nvidia with a big focus today on AI. And we're going to talk about what one serial AI entrepreneur is calling a $30 trillion fantasy. It's not necessarily a reference to Nvidia. It's about Anthropic, but it all involves the evolving economics around the AI build-out. Gary Marcus over at NYU joining us in just a second.
Plus, how that build-out is reinforcing the value of human connection. Renowned interest pioneer Steve Case will join us live on his latest op-ed on AI's influence.
And then we get to those earnings, and we have full coverage of those earnings right here on Bloomberg. The best of our internal team at Bloomberg Intelligence and Bloomberg News. We're also going to hear from Nvidia shareholder Jack Ablin, chip policy expert Chris McGuire, and DataBank's incoming CEO Kevin Ooley, amongst others. Stick with us. This is The Close on Bloomberg. A muted advance in personal consumption expenditures last month may be giving the Fed some breathing room on rates. Our next guest says the risk of a Fed hike will depend on how impatient committee members become with inflation hovering above that target. Meera Pandit joins us right now. She's an executive director and global market strategist at JPMorgan Asset Management. And we should say hovering, it's been hovering there for more than 5 years now. But it gets to this idea as to exactly what you think the Fed will pay most attention to. I mean, 3.3 on a core, not 2%, but it's not exactly, 6, 8, 9% where we were just a few years ago.
The longer we stay there, though, the worse it feels. And I think the challenge here is that there are many signs that inflation could come down to 2% perhaps next year, but probably not this year. If we think about what could get us to 2%, we are seeing that wages overall have been muted on a year-over-year basis, probably the slowest pace of increase in 5 years. So that should help things like services inflation. We've seen a lower average level of tariff rates this year versus last year. That could also take some gas out of core goods. And then you look at shelter, and rental vacancies have actually been at a 10-year high, so that could help ease rents. But if that doesn't happen for another 6 to 12 months, how patient can the Fed be with this persistent inflation overshoot, especially with the changing of the guard and Warsh's overtures to wanting to be resolute in combating the inflation that we've seen? Well,
this gets to this idea, too. Kevin Warsh is scheduled to speak on Friday morning from Jackson Hole, Wyoming. It's supposed to be one of those wonky policy speeches. Everybody's hoping it will be more than that. But it gets to this idea that Warsh has kind of made it clear that he wants to communicate maybe a little bit less than his predecessor, and he wants to rely maybe a little bit more on the markets to sort of set the tone for where things go. Does he have the luxury of doing both of those?
I'm not so sure, because he says, okay, let's let the bond market lead the Fed, not the Fed lead the bond market. And essentially, you're not actually seeing tighter financial conditions here that would warrant no more hikes than that the Fed has done its job via the markets. So that's a challenge there. I think that, unfortunately, from Jackson Hole, we probably won't get what we're looking for here. We know we're not going to get forward guidance. We know that we're probably not going to get a clear reaction function from the Fed either in terms of how they're thinking about this fall. There may be some nod to the task forces and the work underway, but he's not going to want to front run that work either. So it's really tricky to think about what we're actually going to get there that is substantive. So I'm thinking about some of the clues. If you get a little bit more around affordability and some of the challenges to the American people, maybe that gives some sort of easing inclination or on hold type of inclination. If you have more of that resolute, we have commitment to our 2% target, maybe that signals a little bit more of the hiking. But again, it will really be reading the tea leaves that he's not trying to give us. So I don't know that the market is going to get what it wants from Jackson Hole. And again, when we think about what the Fed might do this year, the market is pricing in hikes, but ultimately, do they have enough votes among the committee? It might come down to something as technical as the fact that, yes, you have 3 dissents, and yet if you're not bringing more people on side quickly, it's going to be hard to actually get that hike. Maybe you get a hike, but the one and done is probably not going to solve a persistent overshoot if that's truly the committee's concern. So you get kind of 6 dozen, half another, as opposed to truly working towards bringing inflation down or acknowledging that inflation is in an okay place, of which it's hard to really discern across the Fed how they feel about that.
You know, we talk about inflation, and you have to think about AI and all of the issuance that's coming into both the equity and debt markets. How is your team kind of like parsing through what could be the biggest CapEx raise and kind of build out over the next few years? How does that impact inflation?
When we think about it, even from a rates perspective, I don't know that that's the driving force when we think about some of the challenges at the long end. It has to do a little bit more around Fed expectations, broader inflation backdrop, plus some of the global term premia around things that are going on in other markets, like Japan, for example. I don't know that the issuance is necessarily pushing up the long end of the curve. But it is important to think about when you have a capital light industry that has become very capital intensive, materials, commodities, you see it certainly with things like memory prices and how that will translate to consumer electronics. It's not just a producer prices issue. It does become a consumer issue, especially when you think about things like utilities as well. So we have to be mindful that while long term, as Warsh would like to lean on, the productivity benefits should help be disinflationary. But in the short term, it's probably going to be more inflationary, and it probably will, over time, create some fatigue in the bond market like you're seeing in the equity market because there is just that level of supply. And you're seeing it in terms of the shift in how much some of this issuance has been oversubscribed 3 or 4 times among the hyperscalers earlier in the year to maybe something like 1.5 times more recently.
All right, Meera, always wonderful to have you. Meera Pandit there. She's Executive Director and Global Market Strategist at JPMorgan Asset Management. And just a reminder, Kevin Warsh, the Fed chair, is scheduled to speak from Jackson Hole, Wyoming at 10 a.m. Eastern time. We'll have full coverage of that right here on Bloomberg Television. When we come back, we're going to take a closer look at the retail set. We got some interesting earnings this morning out of Abercrombie and Fitch, Bath and Body Works, and Kohl's. We're going to catch up with Dana Telsey when we come back after the break, right here on The Close, right here on Bloomberg. Time now for our top calls. A look at some of the big movers on the back of analyst recommendations. Let's start off with strategy. The folks over at Bernstein cutting its price target on the stock by 22% to $350 a share from $450. Now, this is based on their projection for extended weakness in the price of Bitcoin, at least through the end of 2026. Now, the firm previously had said that it thought Bitcoin could get to an all-time high this year. It says it can still get to an all-time high of about $150,000, but not until mid-2027. Strategy shares down about 3% on the day. We got to take a look at Nike. Truist cutting the stock down to hold from buy. The price target gets nudged down to $42 from $47. The firm now saying that it's incrementally cautious on Nike after those disappointing earnings out of Dick's Sporting Goods. Remember, a lot of people were trying to read between the lines at some of the softness that we saw in Dick's in the most recent quarter, and a lot of the fingers are pointing back to some of its vendors like Nike and Under Armour. Those shares down 2%, a third straight day, their lowest levels since 2014. And finally, TJX, Jefferies citing a material slowdown, at the TJ Maxx parent, cutting the stock to hold from buy, the price target going down to $145, with the analyst warning that slowdown in the Marmaxx business, that's basically TJ Maxx and the home goods, he's basically saying that looks more significant than a typical miss. And those shares are down a second day now to their lowest levels since August of 2025. It's been sort of a really mixed bag, Emily, when we come to the retail earnings that we got this quarter. You had some real standouts out there. I think about Estee Lauder, really surprising to the upside. And then you had some disappointments. Walmart, which actually raised its guidance, but still had some of the slowest year-over-year, growth that we've seen in that company in about 6 years. We're going to get Urban Outfitters later tonight, and we got a few earlier this morning.
I mean, Abercrombie absolutely blowing it out of the water. Those shares as much as 42%.
Well, let's talk about Abercrombie and Fitch and bring in Dana Telsey over at Telsey Advisory Group. And Dana, let's get right to it. I mean, we'll start off with Abercrombie and Fitch. We're looking at a stock that is setting up to be probably one of its best days ever. What's going on here? Because it seemed like this was a huge turnaround story. Investors were loving it. Then it fell out of favor. What did we learn this last quarter that made everybody fall back in love with it?
What made everyone fall back in love with Abercrombie, besides the fact that could be some short covering, is the fact that you had growth in the Hollister business. Look at the new partnership extensions they have with Target. You have growth in the Abercrombie business with category expansion, along with partnerships like the NFL. You're basically also seeing AUR increases, clean inventory, the balance sheet solid, and yet a beat and raise. in retail today, having a beat and raise is valued, but more importantly, they're capturing new customers. So capturing a new customer base with new partnerships and product extensions, it only sets up for bigger sales and earnings going forward, and that's encouraging. And it's a cheap multiple to begin with.
Yeah, maybe that's why you're seeing the stock up more than 30%. Coal's not actually having a bad day either, up a couple of percentage points. This was also a turnaround story, and it looks like the turnaround seems to be going. Dana, what's your take?
Yes, I think there is some improvement in coals. When you think about the merchandise categories, all the major categories improved. They're not as reliant on Sephora as they had been in the past. Home was solid. The first time they saw traffic only slightly down since 2019, so it's their best traffic number since 2019. And you're also seeing the fact that their credit card customers are coming more frequently, and it's moving higher. So good to see the beginnings of improvement, and I'd say the same things about Bath & Body Works who reported. They had the first quarter of increased sales in the direct channel since 2021. So the sequential improvement in body care, the stronger average unit retail selling price, and now you're being sold both on Amazon and in Ulta. Channel expansion is driving new customers is a theme for retail.
All right, Dana, what does it mean then for the Urban Outfitters story that we'll see in just a little bit? Because this has been a really mixed season for earnings, but at least today some of these retailers were pretty solid.
Well, the read across from Abercrombie certainly should be good for Urban Outfitters. We know that their Free People business has been stellar. We know that there's fewer markdowns at Urban. We want to see the response and what's happening at Anthropologie, and their new lead business has shown double-digit increases. The read across should be positive for Urban when they report after the close.
So if it's positive when they report after the close, it gets to this idea, Dana, is what's been sort of the storyline that you've seen through this earnings season amongst other retailers and consumer product companies? Is there a narrative, or is this just all sort of idiosyncratic stories?
I think overall discretionary is coming back. We've seen the promotional headwinds of active, obviously look at Nike, impacting footwear, yet you have fashion footwear companies like Steve Madden performing. So fashion and newness are really being recognized, and the marketing investments that are being made are helping to drive expanding customer bases. That's the story to me. And if anything, the back half of the year, given the noise in the numbers with tariffs, I want to see those organic sales growth rates.
Dana, always a pleasure, always smart. Dana Telsey, the CEO and Chief Research Officer over at the Telsey Advisory Group. A look at Kohl's, a look at Urban Outfitters, Bed Bath & Beyond, and of course, Emily, that phenomenal day that Abercrombie & Fitch is having. Preppy is back, I'm told.
Preppy's back. The moose is back.
The moose is back.
Actually, the moose is quite small now on their clothes, but, you know.
All right. Well, we're going to move back from retail and back into the world of tech. We're taking a closer look at Nvidia. The shares lower as we head into that earnings print. After the bell tonight, Gary Marcus is up next. 3:30 p.m. in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Emily Grafeo.
You know, Emily, as we count down to Nvidia tonight, we're also counting down to an IPO from one of Nvidia's biggest customers and biggest investments, the AI lab Anthropic. While no date has been set, Bloomberg reporting does suggest a formal S-1 filing for the launch is imminent. Many investors are excited, but not necessarily Gary Marcus. He's the psychologist and cognitive scientist who's been very pointed in pointing out flaws in the race to build and commercialize LLMs. In a Substack post yesterday, he took aim at a Wall Street Journal report that suggested Anthropic is likely to tell investors its potential revenue opportunities are more than $30 trillion. Marcus calling that number a fantasy. The NYU professor joins us right now to talk a little bit more about this, Emeritus professor over at NYU. And Gary, I do kind of want to start there. I mean, we know these companies throw out these TAMs, these total addressable markets. We saw a gigantic one with SpaceX. I guess Anthropic decides it needs to one-up them. But do we have any sense here that when they start to talk about this, whether any of that materially can actually be captured?
I mean, it seems to me like a crazy number. It's about the size of the GDP of the United States. And it's true that AI is affecting lots of parts of life. Lots of people are using it for lots of things. But not everybody is using it. Not everybody is satisfied with it. Of course, a TAM is supposed to be the market opportunity, but they're saying the market opportunity is the size of the U.S. economy. And to me, that just seems a little bit crazy. If they took away a factor of 10 and said 3 trillion, sure, maybe even 6 trillion, but 30 trillion is pretty hard to fathom. Now, this is just a rumor. We haven't seen the S1.
Yeah.
Maybe they're floating to see what they can get away with, but it's just sort of a mind-boggling expectation that they think that their market is that big.
Well, one reason why that number jumped out at me is because, I mean, if basically Anthropic is a big end consumer of Nvidia stuff, and we're focused on Nvidia's earnings. So if we're getting fantasy numbers out of their buyers, what does that say about the valuations or how we should be looking at Nvidia's own order book, or at least what they're projecting that order book to be?
I mean, I think Nvidia is a great company. It's very well managed. They've built a terrific ecosystem, but I am getting more and more worried that they're talking about all of these kind of future orders that they're subsidizing. What happens if those subsidies go away? What if those companies can't actually buy them? I don't know exactly what to tell you about what Nvidia should be valued at, but I think we have to look at all the circular financing that's going on, and we have to look at the fact that they're connected to companies like Anthropic that are making these wild projections that don't seem particularly plausible. I'd also be worried about Nvidia's dependence on OpenAI. OpenAI, I think, is weaker than Anthropic. I think they're burning money faster. I don't think they're as well managed. Suppose that OpenAI has to sell in a fire sale, and one of the big companies, Nvidia or Apple or Google or something like that, buys them for 20 cents on the dollar. Like, how is that going to affect the rest of that market if that happens?
I mean, I want to stay on the circular financing here, because do you think that it's making the AI demand actually look stronger than where the actual underlying economics are right now?
Well, I think that's everybody's worry. And, for the most part, we're not actually party to the contract, so we don't know what's been pledged and how it really works and so forth. We sort of get the top line. But I think the concern a lot of people in the financial industry at this point is the revenue, in some sense, not really telling the full story because of the way that it's being booked through these circular deals.
I mean, so we have a $30 trillion TAM. We have Nvidia and multiple financial partners talking about a $500 billion partnership. We had Bloomberg reporting just a week ago Broadcom potentially eyeing a $100 billion debt sale. These are huge numbers, Professor. Any worry here that it's just the sign of the top of a speculative cycle?
For sure. I mean, it's very hard to time things, right? Think about the Dutch tulip craze. And tulips went up and up in value. It reached a point where I think a lot of people probably thought it was insane, and then it went up a little more, and then it crashed. And it's very hard to call the actual top. I wrote a piece last year called Peak Bubble, which was about when Oracle jumped up to like 320 or something like that. And I didn't say that that was the peak of the bubble, but that people would remember that moment as the peak of the kind of mania of like Oracle, I think it went up 40% in one day because they'd made one deal with OpenAI. And eventually people realized that is not a good reason to make Oracle be worth $320 or whatever. And you have to actually take it in context of like how much debt is out there. And how likely is OpenAI to actually make the payments that it allegedly would make? There was a Times op-ed today that said all of this debt is bonkers. That's the word that Times used, and I remember it. And to me, it seems bonkers. Like, I just don't see how it's all going to cash out.
Well, I mean, this gets to the idea. I'm glad you brought up Oracle. I mean, because you go back to September of last year, we saw that, like a 44% jump in the stock, and it's pretty much round trip since then. And it gets to this idea as to who should we be looking to, Gary, in terms of companies for, I guess, that proverbial canary in the coal mine. If it's not Nvidia, is it a company like Oracle? Is it the neoclouds? I mean, who might be best representative of that excess if and when we finally do reach that bubble pop moment?
I think in that sense, the two companies I'm looking at, or three companies I'm looking at, are Oracle, CoreWeave, and OpenAI. I think that they're in some ways the most vulnerable. I don't think Nvidia is quite as vulnerable as those, but we might see Oracle take a big hit. We might see OpenAI. I don't think it would go out of business, but I think that we might start to see it as the WeWork of AI, like kind of overvalued, maybe doesn't actually get to its IPO. Same thing with CoreWeave, like to me, it's difficult to understand what's going on relative to all the debt that they're taking on, all the money that they're burning. But also, because it is this big circular cycle, Bloomberg in print had a wonderful diagram of all of the feedback cycles that are going on. They're all interlocked. So if any one of these companies stumbles, then a lot of people are going to have pause about the rest of them. There's not, one of these companies sort of independent of the rest. Their fates are tied together.
Hey, Gary, before we let you go, I do just have to get your thoughts. I mean, being a psychologist, a cognitive scientist, to get your thoughts a little bit more on kind of where just technology is taking us overall. I'm sure you had a chance to read the missive by Bill Gates, the founder of Microsoft, talking about what he sees as a need to have a more serious conversation about how we approach this technology and maybe some of the guardrails we start to put up to protect society. There was just a big settlement earlier today from Meta and its approach to social media and teens. Do you have confidence that where this technology lives in our lives now and where it may be in the future is actually going to be additive and constructive? Or is there something a little darker?
No, I'm very worried about that.
Why?
Gates' letter today is actually a lot like a book I wrote a couple years ago called Taming Silicon Valley, which I started by pointing to Meta and saying they said, move, you can actually see in the frame, move fast and break things is kind of like the Meta way of life. And that finally caught up to them a little bit today in the settlement that they made. But as I argued in that book and as Gates argued today, we don't really have a plan here. I tried to lay out the best that I could in Taming Silicon Valley. I think 9 different ideas around regulation that we should consider and so forth. I think Gates made a lot of good points. One of them is we need to deal with this democratically. It can't just be the companies. It can't just be the government. We have to have the public voice in it. And we have to ask that question every single day. Is this stuff on balance going to be a net positive society or net negative for society? There's obviously advantages. So, for example, coding goes a lot faster, and there are obviously disadvantages like deepfakes, disinformation, more cybercrime, etc. I'm constantly trying to balance that, and everybody who's watching should be asking that same question. Okay, there are advantages, there are disadvantages. Where is this going? Is it on net going to be positive for society? And what can we do to try to shift it so that it is positive? Like, what can we do in regulatory terms or financial terms and so forth, tax terms?
All right, Gary, got to leave it there. Always appreciate it. Gary Marcus, Emeritus Professor of Psychology and Neuroscience over at NYU, the founder of Robust AI and Geometric AI. We're going to talk a little bit in a moment more about that Meta settlement, but a redhead crossing the Bloomberg terminal that could actually affect the AI space. President Trump is signing an emergency order that aims to keep some foreign-made transformers and other critical energy equipment out of the nation's electric grids. This is based on national security grounds. This is based on people familiar with the situation. We should learn a little bit more about this, but of course, a critical component of the AI build-out is the ability to sort of get these power and transformers out there. We'll be back in a moment. This is Bloomberg. Our stock of the hour is Meta. The shares on the move after the company agreed to a $17 billion settlement in that landmark case brought by multiple U.S. states surrounding teen social media harm. Olivia Carville is a Bloomberg News reporter who's reporting on this story. Is featured in the Emmy Award-winning Can't Look Away, the Case Against Social Media documentary. Were you surprised, Olivia, that Meta decided to settle this before we got deeper into this trial?
Great question. I wouldn't say surprised. I think a lot of people were expecting to see a settlement in this case. I would say surprised just given the timing, because yesterday I was in an airport. I was listening to Adam Mosseri, the head of Instagram, testify on the stand in Oakland. He was expected to be back today. But as we now can see, there has been a settlement that the companies and the state AGs have agreed to, and a judge is reviewing all of that paperwork right now. And as you said, it's up to $17 billion. And I think the most significant thing here is actually the product changes. And I imagine that's something that we'll be discussing in this segment.
What about the significance of that size, $17 billion? Is it really going to make a dent for Meta?
I mean, another great question. You have to look at the size of Meta. They have a market cap of over 1.4 trillion right now. In the last quarter, they had over 60 billion in revenue. So you kind of weigh it up and say, hold on a minute, 17, 18 billion dollar settlement, is it really going to move the needle? But the bigger question here is really around those product changes. Yeah. That's where everyone is turning to, looking towards. This is the first time the company has made such significant changes to how teams are going to be using its product.
Olivia, walk us through what those changes are, please.
Sure, there are a raft of safety changes that have been announced. Some of the most significant that I think will really change how teenagers use Meta's platforms is they're going to be turned off. They're going to go dark during nighttime. So from midnight to 6 a.m., teenagers will not be able to access Facebook and Instagram. There is a 2-hour limit on teenagers using these products on a daily basis. You're also going to see notifications switched off during school hours. All of these changes are trying to give teenagers back their own autonomy over their time, rather than being glued to a screen, kind of nonstop watching social media and watching these platforms. They're going to have to put the phone down. And I think that's what these changes are going to enforce.
All right, Olivia, appreciate you joining us. Olivia Carville, you have to check out, if you haven't seen it, of course, that documentary, Emmy Award-winning documentary that is really based on all the reporting that Olivia Carville has done on this issue, reporting, of course, that led us to a courtroom and led us to what we learned earlier today was a big settlement by Meta to hopefully make all of this go away. The countdown to the close continues. The countdown to earnings from Nvidia is upon us. That conversation and more coming up after the break right here on Bloomberg. Welcome back to The Close. We're just about 10 minutes away from the close and, well, just a little bit more away from Nvidia's earnings report. I'm Romaine Bostic.
And I'm Emily Griffeo. Romaine, investors not really putting a lot of risk on, at least before these Nvidia results. They're actually selling Nvidia right now. That stock down about 1.5% heading into the earnings release. On the index level, not that much movement, a little bit in the green. S&P 500 up about 0.1%. The story of the day, at least before Nvidia, is really on yields here. That's been a focus not only today, but really for the whole month as those long end yields were moving higher. But we're actually seeing more movement right now in the shorter end of the curve, the 2-year yield moving up here on a soft, a benign PCE print, but one that did up traders' expectations for when we'll get that Fed rate hike. That's also moving the dollar up as well.
All right, Nvidia under pressure right now, down about 1.4% into the print. The expectations in the options market for tomorrow's cash session is an implied one-day move up or down of only 5%. Yeah, things have changed. John Belton joins us right now, portfolio manager and managing director for growth portfolios at Gabelli Funds. And I do kind of want to start there. I mean, we've talked about this. Earnings expected to double. Revenue expected to double. Margins expected to be fat. I remember, I think it was last time we had you on ahead of a Nvidia print, and we talked about this idea of the results being predictably strong. And I'm wondering if that word predictability might actually be working against this stock right now.
Yeah, thanks, Romaine. I mean, it's interesting that 5% implied move by the options market. I don't think, you can check me on this, but I don't think Nvidia's had a 5% move on the day after earnings in any of the last 4 quarters, and it's been slightly down on each of those prints. So I think we've just entered a new phase for this stock. It's no longer being driven by, earnings revision shock and awe like it was a couple of years ago, certainly in 2023 and some of 2024. We're now kind of facing the bigger picture, longer term questions, which are harder to resolve on any single earnings print.
Well, give me a sense here. I mean, aside from the actual overall revenue and EPS numbers and margin numbers, I mean, what's the thing that you look for out of this report and the conference call that justifies not only the valuation, but really this being sort of a long-term growth story?
Well, you still do want strong revenues, and I think we will get that. We're going to hear them talk about this Blackwell product ramp, started shipping a couple weeks ago, ramps into this quarter and more sharply into the January quarter. We're going to hear them talk about, I think, this Neo Cloud opportunity, which there's been a lot of things happening behind the scenes over the last few months they seem pretty optimistic or bullish on that, but they're going to have to also defend that strategy, because with that comes a lot of these circular financing dynamics that the market has become concerned about. So I'm more focused on the qualitative commentary on a lot of these big picture items, assuming that the fundamentals, the revenues, the gross margins are going to be strong, which I think at this point is a pretty safe bet.
So what would that qualitative commentary look like for you to get maybe more bullish on the stock?
Well, I am pretty bullish on the stock, to be clear. And to take a step back, there's not really anything wrong with this stock. It was up 40% last year. It's been a little volatile, but still roughly performing in line with the market this year. But anyways, in terms of these big picture questions, I want to hear them talk about Blackwell. I want to hear them defend that architecture, talk about, how they feel it's superior to these competing offerings from the likes of AMD and these custom accelerators that some of the hyperscalers are designing. So I think that is first and foremost what I'm going to be looking for on this call. On that NeoCloud strategy and that whole offering, I wonder if they're going to share any details about some of these new financing structures that they've put in place to help facilitate new developments. And I think, some of what's going into effect is going to be the potential to share in some cloud services revenue, which could present sort of a new upside vector for numbers. So I think that's going to be interesting. And then, everything they're doing around networking and sort of fast inference accelerators as well.
Okay, so John, I have to admit, I focus on credit, and I am curious kind of how you're thinking about what it means for the equity, the stock price of Nvidia, if they are to come out and talk about, even more circular financing deals that they're doing and even more, backstops than they've already announced.
Well, I think to take a step back, what are they doing here? They're providing guarantees to developers who are building infrastructure to run NVIDIA product. And these guarantees mean NVIDIA is going to take down any unleased capacity, which they're going to use themselves in their own model development program. So I think that's a little bit different than directly lending their own balance sheet. That is not what they're doing. And I think that makes a lot of sense. I think, first of all, they do have a model development program or strategy, this Nemotron family of models, which is really successful, and it's actually building a lot of traction and it's very impressive in its own right. So I think it makes a lot of sense to do what they're doing, because the fallback is effectively an investment in their own model development, and the upside is they're accelerating the build out of NVIDIA infrastructure with the ability to participate in upside.
I do want to ask you about NVIDIA's pricing power. Particularly, we heard, obviously, it was a couple weeks ago, about potentially a 15% price increase. And they're raising prices, we should point out, on some of their older model chips as well. How much does that pricing power hold, given some of the potential competition coming down the wire?
Well, yeah, you mentioned some of the rental rates for older NVIDIA infrastructure that's being offered by the public clouds today really speaks to the pricing power. I mean, these are, 3-generation-old Ampere processors in public clouds. Rental pricing is up something like 20% year to date. So just speaks to, this is an architecture that's several years old, and there's still significant demand for it. So clearly they do have pricing power. I don't think that's the issue.
Yeah.
In terms of these new price increases that have been reported on, I think the question there is, what exactly are the specs with those products? And specifically, what are they doing with some of the memory specs in those products, given what's happened to component costs there?
Yeah, it's kind of interesting too. I mean, you look at how old some of these things are, and the idea that they still have pretty strong pricing power on that. What about the new stuff? I mean, you go back, what was it, on August 21st, when Satya Nadella and Microsoft, tweeted out how they had finally received that first big Vera Rubin system here. When we talk about the guidance that everyone's going to be looking for out of Jensen Huang, how much is Vera Rubin already sort of in the guidance that we already have, and how much more room, top line room, does he have to sort of bump that up?
Yeah, I think specifically on Rubin and sort of the cadence of revenues over the next couple of quarters. Now, Rubin is starting to ship in the October quarter, but the real ramp will happen later this year and into next year. So I don't think this is the big Rubin quarter where that starts to show through. In terms of pricing power on Rubin, to the earlier part of your question, I just think this is going to continue to be a market where the players at the frontier, the willingness to pay for something like an Nvidia processor is enormous. And so I think they will, as long as they are at the leading edge in terms of performance per watt, performance per dollar, they will be able to charge for that. So I think everything else will commoditize more quickly as soon as kind of industry supply demand get into better balance. But I still feel pretty good about what their pricing power looks like.
All right, John, great stuff. John Belton over at Gabelli Funds, counting us down to the close and counting us down to those Nvidia earnings. And Emily, here's what we are expecting for the second quarter: $92 billion in revenue, about double what it was a year ago. Of that, hyperscaler revenue is about $43 to $44 billion of that. They're still doing edge computing and graphics, but obviously a much smaller business. Adjusted gross margin, 75%, which is just a bonkers number. And of course, the expectation is that for the guidance for the current quarter end, that we could top $100 billion on top line for the current quarter.
And this is a stock, as a reminder, is up 350% over the last 3 years alone. The bar is just getting higher, I would say, but
the bar's getting higher.
They continue to beat,
but it's still
and that multiple's going down.
But it's still been a relative laggard in the market over the last few weeks. Hasn't hit a record high in a while. There's 79 buys on this stock. There are 2 holds, and one person has a sell rating.
Who's
on
the
this
person?
stock. I don't know, but
Who's the brave
we
soul?
actually asked them to come on the program. We have not heard back yet, but certainly a brave soul. We get the closing bells here in New York. Our full coverage of those earnings out of Nvidia about to start in just a second. Most of the major indices in the red, with the Dow down 0.2%. The S&P is going to finish the day flat. The Nasdaq Composite down 0.1%. The Nasdaq 100 up about 0.1%. The Russell 2000 closing out the day down by about 0.2%. All right, we are going to say goodbye to Emily Grafeo as our coverage as we await those earnings out of Nvidia. Don't forget, we're expected to get earnings as well out of other companies, probably going to be overshadowed, but that includes names like Salesforce, probably the most consequential one that we are expected to get here in the after hours trade. We're also going to hear from Okta, CrowdStrike, Synopsys, as well as Hewlett-Packard Enterprises, or Hewlett-Packard Inc., excuse me. We're also going to get a couple of retail reports out of Urban Outfitters and Gap. But as we await those earnings from Nvidia to update us on just exactly how fast the high-tech side of all this AI is really scaling, there's a lot more to talk about here when it comes to the lower tech ramifications of it all. Now, some of that talk, we should point out, it started as far back as October of 1982. That's when the futurist John Naisbitt published the book Megatrends, where he argued that the more high-tech our society becomes, the more it will crave what he calls high touch. Now, around that same time, a young brand manager for Pizza Hut named Steve Case, he was hired by a tech company to help with a service that let owners of the Atari 2600 download video games over their phone lines. That company would eventually morph into America Online, which turned the cold technological infrastructure of dial-up modems into something very human: connection. The internet boom born out of that has now given way to an AI boom that some folks say is fraying that connection. Just yesterday, Bill Gates, whose Windows operating system arguably did just as much to connect us all as AOL, published an essay outlining his fears and solutions to where this technology is taking us, calling AI analogies to the internet boom insufficient, saying we have no experience with the technology that can be adopted quickly or that can think and move like a human. When the PC came along, he said it took 20 years to significantly change how we worked because the software had to be developed, the price had to come down, and people had to learn how to use the tools and incorporate them into their processes. AI, on the other hand, it runs on the devices we already have, and it uses natural language. In his words, we don't have to adapt to it because it can adapt to us. That was written just a day after Steve Case himself published an op-ed for Bloomberg Opinion saying, quote, technology changes what we value, often in ways that we don't see coming. Pleased to say that Steve Case joins us right now to talk a little bit more about that. And Steve, I do want to talk about that book and more importantly about the foundation of what Naisbitt was getting at and kind of where that's led us to today, not only as human beings, but more importantly, for our audiences as investors?
Yeah, I remember reading that book over 4 decades ago. I was really inspired by it. Then ended up co-founding AOL in 1985, so about 40 years ago. And we focused a lot on building digital communities. That was the heart and soul of AOL, people connection and chat rooms, things like that. And that's driven us forward with social media, and that digital connection still has a lot of value. But in an increasingly digital world, now an increasingly AI world, I think we're seeing more and more evidence that people are really thirsting for real relationships with real people in real places, which is driving a lot of investment in real estate and hospitality, including what we're doing with Revolution Places. So in some ways, it comes full circle. We're still building communities, but now doing, instead of digital communities, more physical communities in places like Hawaii and Costa Rica, and some of the work we're doing through the Exclusive Collective.
Well, I mean, you talk about that in your Bloomberg piece and where a lot of the money is moving, the idea of a focus on land, the idea that you have someone like Bernard Arnault, who most famous for selling, handbags and champagne, focusing a lot more on hotels and experiences. And we've had a whole host of CEOs on this program, including in the AI space, actually talking much more about how those experiences are going to become much more valuable, maybe, than some of these LLMs themselves. Is there anything analogous out there that you see to draw upon, or is this just completely uncharted waters?
Well, I think it's been building for some amount of time. Even Goldman Sachs earlier this year came out with a report called the Halo Report, which talked about heavy assets, low obsolescence. Some of this is people are worried that in an AI world, a lot of industries, a lot of business models are going to be disrupted, and they're going to become more ephemeral, which creates a search from an investor standpoint for things that do have more durability to it, do have more of a lasting ability to it. And things around real estate and hospitality are examples, which is why Arnault and Barry Diller and other people have started making investments in this space. And we're seeing this also with people want to travel more with family and friends. This Exclusive Collective, which owns exclusive resorts in Inspirato and One Fine Stay, there's tremendous interest in expedition travel, people wanting to explore and really see the world, but see it in a real way, not just a digital way. Obviously, with technology now, you can experience different parts of the world digitally, and it's really phenomenal, but that's creating more demand to do that in person, just as people listening to music on Spotify want to go see the live concerts. People that are watching soccer, like the World Cup, wanted to watch it together, or if they were lucky enough, actually go to the physical event. It's exactly what John Naisbitt was talking about with high tech, high touch. And I obviously celebrate all the things that technology has done, the internet's done, AI is now doing, but also see that that the touch aspect is becoming much more important, which I think creates a lot of investment opportunities. Some of the companies that have been focused on being asset light, including in the hospitality sector, may in the next 10 or 20 years see the value of ownership, the value of assets. And you're seeing a lot of people diversify who own either technology companies or other things, saying they want to own some harder assets, and real estate often becomes top of that list.
But I'm curious about the evolution, though, of AI. There are a lot of people saying that AI at some point might actually get to the level of being let's just say a little more human, or a little more warm, if you will. And the idea that maybe the human touch that Naisbitt referred to back in the day can actually maybe come from our machines and large language models. Is that just sort of a fantasy, or is that something that you've ever thought about?
Well, I do think that the technology is getting better and better, and it will be able to do a lot of things, including some things we can't imagine. And there are some, complicated dynamics around that. Even what Bill Gates wrote is trying to strike the right balance between being optimistic about what the technology can do, but also recognize there are some unintended consequences that we need to think about. But my experience over now 40 years, even though, again, I spent a lot of time online, of course, I am proud of the work that AOL and so many other companies played in getting the world online, and the internet has been transformative, just as AI is now transforming things. No, I don't believe that being a purely digital experience is the same as an in-person physical experience. And I personally and my family, we like being together physically, not just digitally. We like being in places physically, not digitally. We like experiencing things like a country like Costa Rica, seeing what's possible there, meeting the people there. It's a real community is increasingly important. So of course I'm gonna always celebrate what can be done digitally, but I've seen in my own life and the arc of technology, the arc of business, that there's a growing hunger, really a thirst for this real world aspect. I think it's going to create tremendous opportunities, including for investors. That's what we're trying to do with our Revolution Places group here.
Hold that thought for 1 second, Steve. We're in conversation right now with Steve Case, of course, former CEO over at AOL, now over at Revolution. We are getting some earnings out of Salesforce and CrowdStrike. Salesforce numbers are out. It did beat on several key metrics in its second quarter, including on income from operations, and it's slightly raising its guidance for third quarter revenue to just above what the street was looking for at about $11.4 billion, now saying it can get there in a range of $11.4 to $11.5 billion. Those shares are getting a strong bid in the after-hours trade. CrowdStrike also out with its results, a beat and raise quarter for them as well, although we should point out the raise is relatively incremental. Revenue guidance for the current quarter of 1.52 to 1.53. The street was looking for 1.52. The shares up 9%. We still await those earnings out of Nvidia, and we do want to get back to Steve Case. Of course, Steve, you kind of ran the defining company of the last great sort of big tech build out when it comes to AOL. I do just want to get your thoughts on kind of where we're going, not so much with Nvidia specifically, but with the AI build out, the investment in it, and whether you see any parallels to what transpired back in the 90s and early 2000s and what's transpiring now in 2026.
Well, there's definitely a gold rush mentality now as there was 25 years ago. People not really paying attention to the internet, suddenly recognizing the potential it can have. And similarly with AI, it's gone from building up over really 75 years and suddenly accelerated in the last several years. And that will lead to some excesses. There will definitely be some companies where valuations are too high. There would be some investment in physical infrastructure, data centers, other things that will end up not working out economically. But people recognize that this really is a transformational moment, and they want to make sure they're positioned to be part of it. So that's what happens with these new technologies. When they really take off, everybody wants to be part of it. It goes from nobody cares about it to everybody wants to be in the middle of it, and we're seeing that dynamic. But I think the bigger megatrend on AI is not just the focus on the LLM, sort of the horizontal platform AI, but what's now happening with vertical AI in sectors like healthcare and farming. We're investors in Tempest AI. We're investors in, which is focused on healthcare. Anduril's focused on defense tech. Carbon Robotics is focused on ag tech. They're using AI to really reimagine big industries. And I think that's going to be the next big opportunity. It's going to shift from a few big companies that are focusing on the platforms, Anthropic, OpenAI, et cetera, to really dozens, potentially even hundreds of companies focused more on vertical AI. And that's happening all across the country. What we've done with our Rise the Rest investment strategy around regional entrepreneurship, we're seeing a lot of momentum around vertical AI.
Well, I'm curious, and I actually caught up with one of your colleagues, David Hall, a couple of weeks ago, and we talked a lot about that. But why do you think there's still a lot of skepticism in the public about AI? I mean, we talk on this show a lot about a lot of the upsides, pretty much on that vertical side, the idea of sort of what it can do for more traditional industries outside the normal world of tech. But of course, all you really hear when it comes to the complaints is about the data centers and the power demands and the water demands and the fact that this is all going to take our jobs. Are these legitimate fears, or is this just the fact that the AI folks just don't necessarily have the best marketing teams, if you will? Not to be glib.
Well, I think some of the fears are legitimate. People are concerned about what AI is going to do to communities, what it's going to do to their family, including job loss. And that fear is driving a lot of the dynamics right now. What I've argued for the past couple of years is for the technology industry, including the leaders in AI, to put forth a approach, a framework that kind of strikes the right balance. And by arguing for no regulation, rather more of a light touch, I think they run the risk of pretty significant regulation and a pretty significant backlash, as you're starting to see in a number of states, and over time it'll be countries as well. So I'm very excited by the technology. I'm very optimistic about what it can do. I've seen it in terms of how I live my life. I've seen it in terms of some of the companies we backed at Revolution. But I'm not naive that a lot of people don't see it as a positive. They're not optimistic about it. They're more cautious, nervous, anxious, fearful about it. And as an industry, we need to get in front of that. Otherwise, people are not going to embrace it to the degree that we are all expecting.
Well, this also gets to this idea, though. I mean, when we talk about who the AI winners and losers can be, moving beyond the picks and shovels and the pure play. But if you go back to your op-ed and just a lot of what Naisbitt talked about, are the winners going to maybe be those that are a little bit more human? And I don't just mean, the sort of the non-tech companies out there building the physical stuff, but the idea that the companies that understand exactly how to incorporate humans and satisfy those humans in whatever that endeavor, does that become more valuable as an investment than those that maybe are seeking to replace them?
Yeah, no, I think people, again, a little bit like the asset light dynamic I talked about, the people are looking for ways to use technology sometimes to eliminate jobs in ways that are counterproductive in terms of the relationship people will have in terms of the consumer relationship. We see this in hospitality. We just opened last year a Waldorf Astoria hotel in Costa Rica as part of our Punta Casica development there. And we use technology, including AI, to better serve our customers. But ultimately, hospitality is about a personal experience, and you want to connect with people and have them feel that's been a special moment, and they really want to return, whether it be to Costa Rica or some other place. We've seen that also with exclusive resorts. People are able to book online, but there's a decision fatigue that kicks in. There's too many options. People don't really know when they're trying to pick a hotel or pick a home, which one would make the most sense. So they're trusting real people to help be their guide. And so using technology as part of the equation, but not trying to use technology as the entire equation, I think is a big opportunity in a lot of sectors, including what we're seeing now in hospitality.
Well, that gets to the idea, and you've obviously had a particular revolution, a big focus on entrepreneurship, particularly outside of the traditional sort of coastal hubs like New York and the Bay Area. And there's been a lot of talk about how these LLMs and all of the technology around it, to a certain extent, might actually be accelerating entrepreneurship, as it's lowered the cost of entry for a lot of folks who would have had to go out and try to hire some really high-priced tech talent. And now that in some cases they can rely on Claude and ChatGPT and some of these other models.
I think that's true. I think that any of these technologies are kind of leveling the playing field, just as we saw with the internet. Whole new industries emerge, whole new companies, influencers, other things emerge. We're starting to see the early stages of that with AI as well. And that is a great thing. I think one of the things that makes this country so great, I say this as sitting in Washington, D.C., as we're celebrating our 250th birthday, as America is the most innovative nation in the world. And we've done that by always leaning in the future, always being willing to experiment, always being willing to take a risk. And we've also done it with everybody in all 50 states participating. And some states led the way in the agricultural revolution. Other states led the way in the industrial revolution. Now different states are leading the way in the technology revolution, the digital revolution, the AI revolution. But as a country, we need to make sure we're focused on the future, and we're doing it in a more inclusive way, including launching companies everywhere, not just in a few places, and creating jobs everywhere, not just in a few places, which I think is the best way, going back to your earlier question, to address some of the concerns people have about AI and job loss, is to have them see in their own backyard that new companies are being formed that are creating products and creating services and creating jobs and driving economic growth in their own backyard, not just in some place like Silicon Valley.
Steve, really appreciate it. Steve Case there, the CEO of Revolution, Rise of the Rest, and of course, one of the co-founders and CEOs over at AOL. We continue our coverage here as we await those results out of Nvidia. We should point out that in the post-market trade, it's a lot of tech stocks getting a strong bid. Salesforce up about 12% on the back of its earnings. Okta up about 15% on the back of its. CrowdStrike also up about 10%. And we're just now getting HP Inc. Those numbers also looking pretty good. Their revenue coming in above target, and their guidance for EPS also coming in above target. Joining us right now to count us down to those Nvidia earnings, Pandit Singh, the global head of technology research over at Bloomberg Intelligence, and Ed Ludlow, the co-host over at Bloomberg Tech. Let's start off with you, Ed, out there in San Francisco. Obviously, the big focus today, I guess, will be on the revenue and the EPS numbers, but we already know they're going to be great, Ed. I mean, what can Jensen Huang and his team actually say today that actually might surprise folks?
They're going to be great. You know, double what they were a year ago on revenue, double adjusted EPS from a year ago. The high bar is set against the revenue guide for this current fiscal third quarter, where like buy-side expectations are very high. Consensus on Wall Street is $105 billion. So great. Nvidia becomes another company to book $100 billion or more in quarterly revenue. But if the buy-side got $108, $109, $110 billion in the guide, it still wouldn't be good enough, because thereafter, for the quarters to come, the growth starts to decelerate. The technology story right now is a part of that, right? They're transitioning to Vera Rubin. The platform is in full production, but they didn't ship any units in the July quarter. And so the markets just want to understand, like, is this a new catalyst to re-accelerate growth for Nvidia, or is it not working like that now, generation to generation of accelerated compute platform?
Mandeep, I mean, what are your expectations? Not so much for what happened in the quarter, but the idea of what that guidance will be. And I'm talking really beyond just 2026.
Yeah, I mean, with Nvidia, you have to look, 2028, 2029, because they've already said they have visibility to $1 trillion in revenue through the next 5 quarters. So they're not going to miss. It's more about the durability of this growth, given every other hyperscaler has their own chips. I mean, we heard this week about OpenAI actually testing their own chip out as well. So it feels like every ASIC provider right now wants to ramp up their efforts when it comes to AI inferencing. And traditionally, NVIDIA has made all its revenue with training. Yeah. That's where they had literally a monopoly. Right. But when it comes to inferencing, TPUs have done really well, and that's what you want to hear, how they are faring on the inferencing side.
Well, I am curious about that, and Ed, I know you were speaking to an executive the other day at OpenAI, and you held up that chip that I guess at some point might actually be at scale a more formidable competitor to NVIDIA. I mean, how far away are they from actually scaling that up?
Yeah, I mean, that OpenAI Jalapeno chip was benchmark against Blackwell, not Vera Rubin. And so, like, a lot of critics would say that those custom chips that the Frontier Labs are working on are generations behind NVIDIA. But what Mandeep said about the longer-term growth outlook and whether it accelerates or decelerates, factoring in competition from other computing platforms is a part of it. Bearing in mind now that also NVIDIA is operating in a much more difficult environment where it and its customers and their also rivals are trying to source the same supply chain, fab capacity, memory, etc.
And Mandeep, I am curious too about Vera Rubin overall, and I think we saw Satya Nadella tweet out that Microsoft had received their first Vera Rubin machine. Is this going to be the longer-term growth story? Will there be enough demand for it, and more importantly, will NVIDIA still have the pricing power that they sort of enjoy today for their current products?
I mean, look, when it comes to why companies have to keep upgrading to NVIDIA's latest architectures, the real constraint here is power. When you go to China, I mean, they can use any types of chips because power is not that big of a constraint. What Jensen has highlighted time and again is if your power is fixed, you want the most throughput, and that's where NVIDIA chips and the upgrades they have had, from Hopper to Blackwell to now Vera Rubin, allows you to maximize the tokens per unit of power. So that's the reason why I think everyone is upgrading, because they want to use the chips that maximize that throughput.
Mandeep, you're going to be sticking with us, so we'll say goodbye to Ed Lolo over at BTech. We'll catch up with him later, I'm sure. The numbers for NVIDIA now crossing the wire. In the most recent quarter, the company did say it reported $96.2 billion in revenue. The street was looking for 92.3, gross margin at 75%, adjusted EPS at $2.22. Here's the forecast. The company says that for the third quarter, it sees revenue of $108 billion plus or minus 2%. So hitting that $100 billion threshold that a lot of people were looking for going forward. The company also saying that AI has reached its, quote, inflection point. We'll dive a little bit deeper into what that means. But overall here, it does look like the numbers for the most recent quarter coming above estimates, $96.22 billion, adjusted gross margin at 75, data center revenue at 89 of that $96 billion. That's also above estimates. But more importantly, that guidance for the current quarter that we're in, that third quarter, the revenue now coming in at $108 billion, plus or minus 2%. The company also providing a full year forecast that it says, well, actually, we'll come back to that in just one second. You see the move in the shares, a knee-jerk reaction to the shares is slightly to the downside, down about 2% as we continue to parse through these results. Let's bring in right now Jay Goldberg. He's senior analyst of semiconductors and electronics over at Seaport Research Partners. Jay, what was your initial thoughts here, particularly with that $108 billion guidance for the current quarter?
I think my initial impression is that's a really impressive quarter, and nobody's going to care.
Yeah.
Not impressive enough, I guess.
Yeah, I mean, not impressive enough, but it gets to this idea, and I think I asked this question of a lot of our guests leading up to this, is what can Jensen Huang and company actually say that does impress this market? It's not in the earnings release, but maybe it comes on the conference call?
Jensen is a master orator. He typically can get a few points up after hours just through sheer magnetism. His track record on that hasn't been so great the last couple of quarters, but he's a very good public speaker. He can be very persuasive. And so I think people know that. And so we're going to be reading second and third derivatives of every word he says and interpreting his tone and his bearing to see what his real mood is, see if we can infer what his real mood is. But I think, as much as I'm sort of negative on the stock, I'm sympathetic to them. They're putting up impressive numbers, and it's just very hard for the stock to get ahead. And I think that speaks to a lot of things you've just been talking about for the last few minutes. They're sold out, and where do you get upside when you're sold out? That's not going to change this year. And so for the time being, it's going to be very hard for them to impress anybody enough to really move the stock.
Well, I mean, some of the language in here in the release from Jensen Huang, this idea about an inflection point when it comes to AI, and what he says that compute is now revenue. He also says that Vera Rubin is now in full production. So I understand maybe some of the disappointment for basically doubling revenue and profit year over year, maybe not quite moving the needle for Q2 or Q3. But as we get into 2027 and beyond, does Vera Rubin change that equation for you?
I don't think Vera Rubin alone changes the equation. I think where they're really tight is around production capacity that they can get out of TSMC. How many chips can they actually get? That's going to be a hard constraint for the foreseeable future. What will start to change next year is they'll have Grok, which is a company they acquired, will start to ship in more volume, and that's not under the same production constraints. So maybe we get a little boost from there. They'll have some of the software stuff flowing into revenue next year, the revenue share they're putting in place with the neoclouds. So there's a few possible things that could sort of alter the trajectory, improve the trajectory next year. But there are also a lot of things that can go wrong. It's getting harder and harder for them to do their job. A lot of forces are, beyond their control that are starting to play out.
So give me a sense here as to whether that's something that the company can actually mitigate. I mean, I know you say it's beyond their control, but this is still the dominant player. They have their tentacles in pretty much every AI player out there in this ecosystem. Does that not work to their advantage?
I'm not sure time is on their side. I think that there are real constraints. There's real competition coming. AMD has, on paper, a comparable chip in its Instinct series. That's going to be shipping in volume next year. We have Google with TPU. We have now OpenAI with Jalapeno. Anthropic with its chip will probably be out next year. So we're starting to see actual competition. I think it's safe to say that Nvidia is still going to have the lion's share of the pool of the market, but there's a lot of detail and a lot of pricing questions that will start to come into play as those new chips really get into volume next year.
Jay Goldberg joining us right now here, which over at Seaport Research, the shares of Nvidia under pressure. Mandip Singh, who leads our technology coverage for Bloomberg Intelligence, still with us. I do just want to point out, Mandip, another red headline, this on the company's commitment, saying that they increased to $279 billion from $119 billion quarter to quarter here. So basically more than $100 billion bump. What was your initial reaction here when you saw some of these numbers?
Yeah, look, I mean, when I see the quarterly sequential increase in revenue, they've had a trend of 20%. This quarter was 18%. So you could say sequentially, it didn't kind of stay on that 20% mark. But other than that, I mean, I think everything in the print suggests they're sold out. There is definitely a lot more demand than what they can supply. And I would be curious to look at the disclosure around hyperscaler exposure versus the non-hyperscaler piece, which they typically disclose in the presentation and the earnings call. So from that perspective, the fact that a company like Nscale is renting out NVIDIA's compute at a premium price to Anthropic, that just goes to show that the next Vera Rubin architecture will lift the ASPs, and that is where the frontier labs like Anthropic are looking to rent these chips at a premium price because they are capacity constrained.
But this gets back to the pricing power issue and also protecting the margins, because this isn't just a revenue story for NVIDIA, growth story for investors. It was also the margins. And we have a great live blog for our Bloomberg clients on the Bloomberg terminal right now. And they're talking about that right now, how starting to see maybe slight margin compression. We're basically talking about going from the mid-70s to maybe the low 70s percentage points. So does this become a bigger story for this company? Not so much that they can't sell enough product, but they're not going to be able to sell it with the same fat margins that they've been used to.
I mean, some of the margin pressure is tied to memory, right? We know memory prices have gone up, even though Nvidia has increased its prices, and it didn't show up in this quarter's gross margin. But I wouldn't be surprised if gross margins come down a bit. And look, Nvidia has been offering all sorts of sweeteners to the neoclouds to make sure they are able to buy, maximum they can, because they want to make sure that all these neoclouds, CoreWeave, Nebius, Nscale, they are right up there when you compare them to the hyperscalers in terms of ramping up capacity, and that's good for NVIDIA's ecosystem. So to my mind, the real kind of trend here is what are the hyperscalers doing versus what are the neoclouds doing in terms of renting out capacity, and are they able to command a premium pricing, or are those rental prices going down? It sounds like right now, everyone wants to pay a premium for the latest chips that NVIDIA has to offer, which is the Vera Rubin.
Mandeep Singh sticking with us. We do want to bring into the conversation right now Jack Ablin. He's a founding partner and chief investment officer over at Cressent, a $260 billion family office that invests in NVIDIA here. You've seen the results. You've seen the weakness in the shares, not just today, but quite frankly, over the last few weeks. Jack, are you a buyer in this environment based on what you know?
Well, this is a stock everyone already owns. So, no, we're not doubling down in the name. Generally, what we're looking for is a read on the macro landscape, on the AI landscape, on the data center, and so forth. And in many respects, when it comes to NVIDIA, perfection is the new consensus. So there's very little, I think Jay mentioned, there's very little this company can do to beat these remarkably high expectations. And so in many respects, here's a company pretty much selling everything they're making and have, they're trying to broaden their client base. But this is a company that's sitting at the North Pole. Any step they take is going to be a step south. And so from that perspective, on the individual stock, I would say, that's a difficult place to be. Just they can't snap their fingers and create instantly more capacity.
Yeah.
But I will say, what we're inferring is that the AI landscape is remarkably healthy. We think it's still a great environment. We love the fact that computing costs are coming down, token prices are coming down, and yet what it's doing is spurring more compute, which is something that we've been looking for.
Well, give me a sense, though, on the margins, though. I mean, how much margin slippage are you sort of willing to tolerate as an investor, given, as you say, I mean, they are kind of at the pinnacle right now. So, as you said, I mean, there's got to be a step down. The question is, how far of a step and how much are you willing to tolerate as an investor?
So here's a company that's, operating at a gross margin of 75%. I mean, it's unheard of in most businesses. And so, yes, as they transition, to the new chip, we do expect that there will be some slippage there. But even there, I think we're talking about a couple of percentage points. So they're still going to be in the 70s, and we think that will likely be temporary and will likely trend upward as more and more of their customers want to be involved with these more efficient chips.
So going forward, I mean, what becomes sort of the broader story for you? And I mean, in the AI trade, not just with NVIDIA itself as an investment, but this is a pretty broad ecosystem now. An ecosystem, though, that also has a lot of concentration because NVIDIA has gone from not just being a seller, but also a financer, or at least an arranger of financing for a lot of its customers as well. Does that sit well with you? Does that work to NVIDIA's advantage, or does it maybe come back to bite them?
Sure. I think, it probably does. It doesn't sit very well. They're financing, their customers. We've seen this before. I think this was, rewind back to the internet age, we've seen that. Circular financing. But I think one of the things from an investment point of view, we sort of take the Peter Lynch approach. We just want to own them all. We know that AI will continue. We know that as you as we look at what we call the evolution of innovation, it starts with the hardware. This is sort of the Cisco equivalent of AI right now. It will then transition to the platforms like the hyperscalers, but ultimately the winners in the AI move will be the beneficiaries. So if you think of back in the late 90s, early 2000s of the Ciscos as the hardware, the AOLs or the Netscapes as the platform, it was really the Amazon that was the beneficiary. And when you look at it in terms of performance, their performance, was well eclipsed any of the returns we got from hardware and platforms. And I expect that to be the same this time around, too.
Sorry, I got to stop you, though, Jack. I mean, you said the Cisco word, which for some people is a dirty word in this environment. I mean, we all kind of know what happened to Cisco. I mean, it was at the top of the mountain. It fell precipitously, and it took, a couple decades before it got back to anywhere near normalcy here. Do you anticipate a repeat of that with NVIDIA?
I don't know if, no, because these are companies that are making money, so remember, if you dial back to the 90s, I think we had to measure valuation on, I think it was PE to growth, the PEG ratio, because there were no earnings really to speak of. And so this time around, a huge cash flowing industry. Obviously, that cash flow's come down a lot. We've seen buybacks come down as well. And now, of course, debt placements are going up to the tune of $1.25 trillion, something like that, rivaling the Treasury. But nonetheless, I mean, these are profitable. We're starting on a profitable foundation, and I think that's better. I'm not sure that valuations are as out of whack as they were in the Cisco days. Yeah. But I will say, I mean, Oracle is another one. You talked earlier about that canary in the coal mine. I would watch Oracle as kind of a leading indicator on the industry.
All right, Jack. Great stuff. Really appreciate you joining us. Jack Ablin, founding partner, chief investment strategist over at Cressent. And we do want to talk a little bit more right now about some of those valuations out there, because our next guest is warning, he actually warned ahead of these results that the AI story overall, at least in his view, is still clearly further advanced than it was a year ago, but it is still early. And he says that there will be changes and challenges that face all of the players in this space and the investors in those players. He calls it AI's bar mitzvah moment. Investors no longer willing to just price on promise and start now demanding tangible evidence of progress. Aswath Damodaran joins us right now, professor of finance at NYU Stern School of Business. And Professor, that is my question here. I mean, you were talking about this being AI's bar mitzvah moment. Do you look through NVIDIA's release today, and does it give you a sense overall that they are actually meeting that moment?
No, I think at the moment, here's what I see. We've built the most expensive and biggest factory of all time, the AI architecture. And all the companies that supply the architecture, from NVIDIA, the electrical equipment companies, the power companies, have benefited. But in my view, that moment is now past. The architecture has been paid for the most part, and it might be added to. At this moment, though, the question is, what is this factory going to make, and will people buy it? That's the Anthropic, OpenAI, SpaceX moment. And that's why I call it a bar mitzvah moment. We just don't know.
So we don't know, but I think a lot of people are trying to game the system. Do you have sort of a calculation out there, your math, where you sort of look at the ecosystem out there, where it starts to make a little bit more sense, not so much as to what the aggregate numbers will be, but what that dispersion of some of those numbers will be?
I think one way to do it is to take whatever market pricing you get and reverse engineer from it what you would need in revenues, given whatever profit margins you assume for these companies. With Anthropic, my back of the envelope calculation is they go with a $2 trillion pricing, which is the rumored number for the IPO. They will need about 1.5 to 2 trillion in revenues. And of course, I saw the number thrown around today that their total addressable market is 30 trillion, which is plain bonkers. This isn't even up for debate. Any person who throws a number out like that deserves to be pushed out of the valuation. You're just making up stuff at this point. But 2 trillion is reachable, but it's a big reach. You need people buying products and services in mass quantities and paying premium prices. So you're setting yourself up for potential disappointment.
So, Professor, I mean, this is a company that has a line of business which is growing, triple digit at a $350 billion plus run rate. Do you think there will be like a cliff at some point of time, or it will be a slow deceleration when it comes to the outer years?
Are we talking Nvidia or are we talking Anthropic?
Nvidia.
If you look at Nvidia, I think that they pulled off an amazing trick. They're a design company. They get TSMC to make their chips for low cost, mark them up 900%, and sell them to the hyperscalers. So on both ends of the spectrum, you're asking for pushback. So it's not a question of whether margins will come down, it's when margins will come down. Because both sides are looking for a chance to get out from under the plow. I know NVIDIA is trying to do all kinds of things to keep them bound to them. But I think the reality is, in the long term, the tension is such that margins will decrease. Growth has to come down. You can't keep making the factory bigger if you don't tell me what you're going to make with it. So as you look across time, you're going to see more disappointment than excitement with NVIDIA. It's a great company. Jensen Huang is one of the great CEOs of all time. But amazing companies can also be pretty bad investments. And at this point in time, NVIDIA is, I think, on the edge of that moment when growth and margins come under pressure.
Growth and margins under pressure. I am curious, though, and no one doubts that this is a well-run company. No one doubts the bona fides when it comes to what they've generated in terms of cash, revenue, and profitability. But when you throw out that $30 trillion number, you didn't throw it out, but when other people throw that $30 trillion number, which is bonkers, SpaceX threw out a similar number, it raises a lot of questions because these are, to a certain extent, certainly with Anthropic, one of their end users. So if some of their numbers are fantasy, what am I to make of some of the projections for NVIDIA itself?
I mean, you know what? That's what puzzles me about this. If you're going to sell the AI story, sell it with realistic numbers and a storyline that actually makes sense. Don't tell me fairy tales. So it's almost like they're asking for markets to take another look at them, because when you make up fantasy, you're right. I've got to stop and ask, is the rest of the story also made up? I mean, I know right now people get excited about Anthropic's, annualized revenue run rate. But the problem is that number is like a kindergartner's report card. It's a very, very early indicator of what the company can deliver. I need a storyline that can tell me how you get to $2 trillion in revenues. Don't give me a $20 trillion total addressable market. Tell me a realistic path to a number that can actually justify the pricing. And the fact that you're not doing it is, I think, indicative that you really don't know much about the storyline and how it'll unfold.
And Professor, how do you model the ecosystem that NVIDIA seems to be creating with their balance sheet now by supporting these neo clouds and inference clouds? Do you think that will be durable line of business, even if hyperscalers end up, going on their own over time?
I mean, the reality is you would not do it unless you had to, unless you're trying to sustain something else, because these are expensive ways of keeping your business going. I think what NVIDIA is trying to do, and I don't blame them for doing it, is to make this a fait accompli, that you need to build AI around their expensive chips with expensive data centers, and you do it before alternate ways of delivering AI products and services come through. You remember the DeepMind moment? It was a moment. But it was a moment which said, hey, maybe all of this architecture is not necessary for the bulk of AI products and services. But NVIDIA wants to make the clock run faster so that people say, okay, this is the way it's going to be. We're going to work with what they've created. So I can see what NVIDIA is doing, but it's a risky strategy, because if an alternative way of delivering AI comes about that is a better way of doing it, all of this architecture you've built has to be written off. And no matter how much you try in terms of creating these circular relationships to keep it going, it's not going to sustain it.
Professor, really appreciate you joining us. Aswath Damodaran, Professor of Finance over at the NYU's Stern School of Business. And just to reiterate those numbers, a beat on the top and the bottom line in the most recent quarter, guidance above street estimates for the current quarter, $108 billion in revenue for the current quarter is what it's projecting, plus or minus 2%. And the share reaction, tepid, to say the least. And Mandeep, just before we get to our next guest, I do just want to get your thoughts on this idea, though, about this long-term growth story and the idea that, is there sort of any way for someone at the top of the mountain to, I guess, ascend any higher, as we heard a little bit a while ago from Jack Ablin?
I mean, look at how big this data center market has become for NVIDIA, given it was a gaming company. Now, they keep touting about robotics and how big robotics could be as a line of business. Now, if these LLMs do translate into, a big market for robotics, then I'm willing to pay attention to, potentially another line of business for NVIDIA. That could be huge. So in the end, it comes down to how successful AI is. And obviously, NVIDIA has a big role to play there. But then does it become a big market for robotics down the line? And I think that will determine whether NVIDIA can sustain this valuation.
We're still waiting for that conference call to start. Another number I do want to flag, going back to those supply commitments that we talked about earlier, more than doubling in a single quarter to $279 billion, up from $119 billion, primarily related to securing memory. And as we await those calls, it is putting a big focus, not so much on how much NVIDIA can grow, but the idea of some of the supply constraints out there surrounding the data center build out. NVIDIA reporting $89 billion specifically in data center revenue. Our next guest operates more than 70 data centers in more than 25 markets. Kevin Ooley joins us right now. He's going to be the incoming CEO of the company, DataBank, now the CFO, but will be taking over as CEO at the start of the year. And Kevin, I do want to start here with this idea of how power is kind of really the bugaboo that we've seen in this data center build out. We know NVIDIA can produce the chips. We know you can get these GPUs and CPUs created. But where do we stand right now in making sure that the data centers that you're running and leasing out are actually going to be powered and reliably?
Good afternoon. It's good to be on with you. You're absolutely right. And it's more than just power availability. It's powered land. So we need to have access to the grids, as well as zoned and entitled and permitted land, which is becoming increasingly complex. We operate in 70 data centers, as you mentioned, across 26 U.S. markets, so the largest geographic footprint of any data center provider in the U.S. And that gives us a lot of looks at a lot of different communities and a lot of opportunities, but also challenges as we try to navigate, connecting to the grid in areas that are positive for data centers.
Well, that's what I'm curious about. Like when NVIDIA says, OK, we sold all these chips here, is that landing actually in a rack somewhere and being put to use, or is that just in a queue now waiting for the power? I mean, if a customer came to you and said, hey, I need 100 megawatts, I mean, how soon can you even get that to him?
Well, a couple things on that note. One, we are seeing pre-leases earlier than we ever have. So what that means is they're in the queue. And they don't have delivery of that yet, and they're trying to time their ramp and their installations with our developments such that when they receive them, they can turn them on and execute. So I believe that it'd be more of the queue just based on our conversations with our customers. Secondly, I think that, there's kind of two different markets in this. There's the large neo-cloud frontier training models that are out there that are, less geographic specific. Those are very large deployments. Where we operate tend to be around major metro areas, think NFL cities, try to be within a 45-mile radius, a little smaller footprints, could be a cloud availability zone, could be an AI inference play for an enterprise, whether it's a healthcare or financial services company, and typically deliver those low latent applications that are required for many of the non-training workloads.
Yeah, I mean, look, when it comes to sourcing power, it sounds like that's the real constraint here in the U.S. So do you think it will become easier given, all the constraints we are dealing with and the moratoriums that we keep hearing about?
It's a good question. I mean, you mentioned moratoriums. We've seen New York, Pennsylvania, even my home state here in Texas, all announce something. And it's a hot button for this political election that's coming up. I think, we've been operating for 20 years. We have over 20 data centers in the Texas market. Just to pick on Texas for a while, I think anything that provides a rating structure, guidelines for who can come on, credible people that are going to give back to the community, that are not going to consume water, that operate in closed loop systems, that to try to fight back some of the community pushback. Anything around that is positive, and we support, because it does weed out some of potential speculators. That being said, it's a little premature to find out how this is going to play out, to see how we come out of post-elections, and is there some movement to allow people to connect back to the grid.
Give me a sense, though, here. I mean, you see from your vantage point, given all that you operate there, you kind of see what's real and what's not. And I am just curious about the actual enterprise deployment that's going on right now, and what the gap is now between that and these CapEx numbers that everybody is so focused on, which could, at least by Goldman's estimates, reach $1 trillion this year alone.
Yeah, I think. When you think about when we build a data center, it's typically 50 million a megawatt or 50 billion a gigawatt. And what that is our costs are somewhere between 12 and 15 million. So about 70% of the costs are, the chips and everything that are going into that. So the capital is being deployed, and these are 18 to 36 month cycles. So there's a lot of pre-leasing, a lot of capital that's being deployed and geared toward that, with a lot of power coming online in 27. And so what you're hearing about with moratoriums and trying to plug this gap is really people looking to solve 28, 29, and 30 and beyond.
All right, Kevin, really appreciate you joining us. Kevin Ooley there. He's the current CFO, incoming CEO over at DataBank, of course, backed by a digital bridge. Now, going through those Nvidia results, one line item worth mentioning is the company's revenue from China, or maybe the lack thereof. Revenue attributed to customers headquartered in China, including Hong Kong, was about $7.9 billion for the second quarter. That's less than 10% of total revenue. Now, remember, 3 years ago, that revenue share from China was around 25%. Of course, that was before the progressive implementation of U.S. rules to severely limit the export of advanced chips like Nvidia's flagships A100, H100, H200, and Blackwell. Nvidia last quarter put it plainly, saying the U.S. had, quote, effectively foreclosed on Nvidia's ability to compete in China's data center compute market. Chris McGuire joins us right now. As Deputy Senior Director for Technology and National Security in 2022, during the Biden administration, he was a core member of the National Security Council team that helped craft a lot of these complex frameworks that use the Foreign Direct Product Rule to restrict global shipments of chips made with U.S. software or equipment. Chris, great to have you here. There's been a lot of hay made about those rules that to a certain extent have been softened just a touch since the Biden administration left office. But as they stand right now, do you see a material case to maybe why they should be a little bit looser than what they are right now, or are you more in favor of a more restrictive approach?
I don't see a case for making them looser. In fact, I think the very robust demand for NVIDIA chips that we're seeing and their consistent beating of earnings, including in this kind of blockbuster report, shows that the demand globally is really, really high. And actually, every chip being sold to China is not one not being sold to America and to our allies. I think we're also seeing globally the kind of advent of very powerful AI systems that we in the White House in the previous administration thought were coming. They're now here. And this really underpins the logic of the controls. It's that given that compute is the most important resource in the world, it is strategically critical to deploying the AI systems that are critical for technological advancement, military capabilities, and economic competitiveness. We want to make sure that America and our allies have as much of it as possible. And every bit of compute that we sell to China is something that both hurts us on the strategic front and also takes away from what we have. So I think that we should be tightening them. I think that that right now there actually is such large demand that wouldn't even necessarily move the needle for the companies.
But when it comes to the strategic front, Chris, I'm sure you know this. There are a lot of people that look at some of the advancements that China has purportedly made with regards to chip development, and they would say that those advancements, or at least the speed of those advancements, are a direct result of the U.S. shutting them out.
Yeah, so my response to that would be, if you actually look at the investment data, it shows that China actually did not increase its investment in semiconductor R&D in response to export controls. It actually has gone down since the export controls went into effect. So we actually aren't seeing in the data that correlation that I think is assumed. And actually, when you look at China's advanced production capabilities, it is very constrained. Its most advanced chips are actually getting worse than the previous generation. Right now, they're 8 times worse than the best NVIDIA chip. They're going to move to 17 times worse once Vera Rubin comes out. And they can only make about 1 to 2% of the AI compute as NVIDIA can. So there's just vast differences between the US and Chinese AI chip production capabilities, which is really the core of the competition. And this is what allows us to actually use this as a lever, because it's so hard for China to move up the semiconductor production value chain without the equipment that they need, which we also controlled.
Well, no doubt about that. But I mean, let's be clear. I mean, there have been some relatively credible gaps that people have pointed out. Again, this isn't just the U.S. and China. You have to make sure our allies are on board as well. And while there's no direct evidence of workarounds, there's been a lot of talk about people going through the Netherlands, going through Japan and other countries, finding ways around this where China can actually get its hands on some of that chip-making equipment.
100%. It's both on the equipment, and I'm actually even more concerned about the chips themselves. Nvidia just noted, as you said, that only about 1% of their revenue, their data center revenue this quarter came from China, which is actually up from the previous quarter. But nonetheless, an enormous percentage came from Southeast Asia, from Malaysia, Thailand, and Singapore. Those might be the 3 biggest importers of chips outside the United States. And these are countries that don't have big, robust AI industries. Obviously, what's happening is there's either these chips are being smuggled into China, or there's data centers that are being built in these countries, and then they're being remotely accessed from China. So there is China is accessing U.S. compute and Nvidia chips at very, very significant levels, and the controls do have weaknesses and loopholes, and these are things that should be filled. I think the lesson that we're seeing from the really robust demand, both on the lab side, where they're projecting these historic revenue numbers, and also on Nvidia's side, where their actual earnings are so high, is that there is such robust demand for these chips that if we cut down on that, it would really mean there'd be more capacity for America and our allies and less for China.
But this gets to the idea, and I know you know this, the tech community and Silicon Valley and Nvidia itself have actually said that this could all sort of backfire. The idea that if this is a national security issue, the idea of keeping this technology outside the hands of China, and by restricting that, China's not just going to sit by, they're going to find a way to sort of create their own technology or find it outside of the U.S. The problem now for a lot of these U.S. companies, their concern is that there's no control from the U.S. side, that if China does somehow get to parity or anywhere close to parity with us, they will have full control of that stack rather than U.S. companies.
Yeah, I mean, I think we should be clear that on the chip making side, both on the equipment manufacturing side and the actual chip manufacturing side, China is a long way behind. They're maybe 20 years behind on manufacturing equipment. They don't have any lithography machines that they would need to actually make the chips that are, within that time period. And on chips, they're probably 8 years behind. Their best nodes are 7-nanometer nodes, which are we were first introduced in about 2018 here. So there are very significant advantages on the hardware stack. Now, I agree that we really want the U.S. stack to dominate, and we want to make sure that our models are as good as their models, or better, as far ahead of their models as possible. But the best way to do that is to regulate the amount of compute that they have. It's actually the only lever that we have over China. If we don't do that, I think there's nothing that would stop China from making their models better than the U.S. models. I think the only reason that we have the lead that we have right now is actually due to the differential in compute between the U.S. and China. And if we want to expand that lead, the lever that we have, the only lever that we have, is controlling the amount of compute that China has. And that means closing loopholes and controls.
All right, Chris, really appreciate you joining us. Chris McGuire, he's now at the Council on Foreign Relations and formerly a member of the National Security Council team under the Biden administration. They helped to craft a lot of the export control rules. Mandeep Singh still with us here, who runs our technology coverage for Bloomberg, as we await that conference call from Jensen Huang and his CFO in about 5 minutes' time. We've gone through the numbers, Mandeep. The question now really becomes, is the market going to buy it? And I guess for you, as an analyst, are you buying it?
I think so. I mean, look, all these companies have signaled to us that they plan to raise their capex. In fact, when I look back to the start of the year, expectations have gone up almost 40% in terms of total hyperscale capex. Now, should it translate into 40% increase in hyperscale revenue for Nvidia? At least they should have gotten some portion of it. That's where you could say there was some disappointment. Why didn't the hyperscale beat, go to that kind of an upside surprise? And some of the numbers were revised upward, but I think that's where maybe you can say there was a disappointment.
I do want to ask you about those supply commitment numbers. Is this just Nvidia hoarding, trying to hoard for itself and ensuring that it still has an advantage as maybe some competition comes down?
Well, look, Nvidia is also training its own models. So they keep releasing an open source version of their model that they are training. So that's where Nvidia is a company that has got ambitions beyond being a chip player. They want to have a model model, create an ecosystem around it, create a robust open source ecosystem. So from that perspective, they're doing a lot of things, and they want that compute capacity to be used internally as well.
You know, we didn't get a chance to talk about Salesforce. I thought SaaS was dead, Mandip.
No, I mean, I think you're seeing companies that are seeing sequential acceleration and top line do well in this quarter.
Well, Salesforce is the biggest mover in the after-hours trade, up about 13%. Nvidia shares under pressure. Our thanks to Mandip Singh. We're going to have a pen and paper interview with the CFO of Nvidia later on Bloomberg.